In today's class, we're going to be talking about the big question: what causes inflation? Of the two main types of inflation, we will start with demand-driven inflation, which is usually temporary. See, demand-driven inflation is caused when there's a demand shock. For example, you own a company that sells t-shirts. Usually, you sell 100 per day. But recently a famous actor was seen wearing your shirt and demand all of a sudden jumps to 300 per day. However, you only have the capacity to make 100 per day. Theoretically, the price would rise until the 100 people are left who would pay the most for your shirts. This isn't a perfect process, but overall the gist of what happens when demand way exceeds supply. Typically this is temporary because the original business owner is likely to realize that they can sell even more shirts and make even more money while growing their business. They are likely to ramp up capacity and produce more shirts. Or even if not, and they like the new profit margin, they want to keep selling 100 shirts but at a higher price, a competitor will likely see that opportunity to swoop in and sell shirts for a lower cost and take business from that original owner. The expansion of the money supply is typically what people think of when discussing price inflation. This occurs primarily when governments print more money. Typically this is permanent, as money is rarely taken out of supply once it's put in, at least in any major way. Why this happens is a topic for its own video, but just know that once money is printed, it isn't unprinted. Why do prices rise during periods of money printing? Well, don't think of this as a good, say a t-shirt going from $10 to $11, as getting more expensive. What happens is the money becomes less valuable. See, there's more overall dollars chasing the same amount of goods and services. So the dollars become less valuable by comparison. And this is why we see basically everything rise in price during periods of high inflation, be it food, energy, housing costs, or things like investment real estate, stocks, or other investment assets. The more difficult it is to produce something, aka the scarcer it is, the more the price rises in relation to the increase in circulating money. It's easier to print twice as much money compared to building twice the number of houses. So housing becomes scarcer in relation to the monetary unit and rises in price denominated in that money. Inflation really isn't that complicated as far as what causes it, although why money is printed or possible ways for a demand shock is a deeper topic. I do hope to have some videos on these in the future, but let me know in the comments if there's any topics you would like to see, and watch this video on the end screen for why inflation is a bigger deal than you think.